In this presentation, we will take a look at itemized deductions related to interest payments. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Remember that as we talk about itemized deductions, we will only be taking the itemized deductions if they sum up to an amount greater than the standard deductions. The standard deductions, depending on filing status, note that the standard deductions have gone up for 2018, a list being down here: single 12,000, married filing jointly 24,000. Starting in the year 2018 and going forward, the amount treated as acquisition indebtedness for a period cannot exceed 750,000. This is a change from last year, a lowering from last year, but note it shouldn't affect most taxpayers who own a home. Remember, what we're talking about here is the loan on the home. So if we bought a home for 750,000 and we had the whole thing financed the entire loan amount, then the interest on that loan would be capped at the 750. And typically that's not the case. If we bought a $750,000 house, we would typically put some type of down payment, 10 to 20% on it, and the loan then of course would be something under that. So this is going to be a cap that's going to affect higher income individuals and probably not the average individual. We can then ask what would happen if we took out another loan, possibly at a future point in time. Would we be able to deduct the interest on that loan? As long as the amount is under the 750 for the principals of the two loans, we may be able to deduct the interest on it. However, we need to be able to spend the proceeds from that loan on improvements. In other words, if we take out the loan, the amount of the loan proceeds we received needs to be for the acquisition of the home or for the purchase of improvements for the home. So we want to make sure to be able to track those going forward. In prior years, before 2018, it was possible in some cases to take out a loan, use the home as collateral, and be able to take the interest deduction even though we didn't spend the proceeds of the loan on the home, as long as we use the home as collateral for the loan. For 2018 going forward, we can't take out a loan and be able to deduct the interest even if the home is collateral unless we spend the proceeds on the home. This will be a big deal for financial planning going forward, because oftentimes when we think about financial planning, consolidating debt often includes getting rid of things like credit card debt and debt possibly on an automobile and things like that, and trying to put it on the home loan, because you can typically get a good rate on the loan if we have the home as collateral, and you typically get a tax deduction, or you used to be able to do so, even if you didn't spend some of that money or spend the money or the proceeds on the home. Note that the mortgage interest on the home is often one of the largest types of deductions for itemizing, and therefore one of the items that will push a lot of people over that threshold from standard deductions to itemized deductions. But also note that the standard deduction is larger, so we may not get the same type of benefit from the home loan interest as we would in the past, given the fact that the standard deduction is greater. So another thing to just keep in mind as we think of the home purchase, and if we're taking taxes into consideration as a comparison, the relationship between the standard deduction and the itemized deduction may make the home loan interest not as beneficial as it was in the past. We can also deduct interest that is on indebtedness allocated to property held for investment. So basically investment interest, we can deduct some of the investment interest. However, the investment interest is limited to the net investment income for the year. So we cannot deduct investment interest above and beyond the investment income. If we don't deduct the investment interest, it can be carried forward to future tax years and deducted at points in times when we do have investment income to match up with the investment expenses, with the investment interest payments, with the investment interest deductions. For more accounting information and accounting courses, visit our website at accountinginstruction.info.